By 2030, experts predict that over 20% of Americans will be 65 or older, and nearly half of them will have less than $250,000 saved for retirement. That's not just a number, it's a loud warning siren for anyone hoping to stop working someday. Social Security alone won't be enough to cover rising living costs, medical bills, and the kind of life most people dream about. Building a strong portfolio today isn't just a smart move, it's survival. The real challenge is figuring out how to grow your money safely, steadily, and without falling into the trap of chasing risky investments. So how do you build a future that's truly yours, one where you control your time, not the other way around? Stick around, because we're about to break down the 5 best Vanguard ETFs that could help you retire not just comfortably, but powerfully, and it all starts right here. Vanguard Total Stock Market ETF. The Vanguard Total Stock Market ETF, better known by its ticker symbol VTI, gives you exposure to the entire U.S. stock market. From giant corporations that dominate global industries to small, innovative startups that could become the giants of tomorrow, VTI spreads your investment across thousands of companies. This wide coverage means you're not relying on just a handful of big names to secure your financial future. Instead, you own a piece of nearly every public company in America, creating a strong, resilient foundation. With an extremely low expense ratio of just 0.03%, VTI ensures that more of your hard-earned money stays invested and working for you instead of being drained by fees. Over the past 30 years, VTI has delivered an average annual return of around 10.3%, showing impressive long-term strength even through economic ups and downs. It captures the full economic heartbeat of the country, offering both stability and powerful growth over decades. However, it's important to understand that because it reflects the entire market, VTI will rise and fall with broader economic cycles. Still, for retirement savers who can stay patient and ride through short-term volatility, VTI offers a rock-solid foundation for serious future wealth. Vanguard S&P 500 ETF. Vanguard S&P 500 ETF, or VOO, is another absolute powerhouse option for retirement investors. It focuses exclusively on the 500 largest and most established companies in the U.S., covering industries from fast-moving technology giants to healthcare, finance, and consumer staples. These are the companies that have survived wars, recessions, global crises, and technological revolutions, proving time and again that they can endure and thrive. VOO offers a special kind of reliability through its diversification among the biggest and most resilient players in the market. Like VTI, it boasts an incredibly low expense ratio of 0.03%, making it one of the most cost-effective ways to tap into American prosperity. Over the past 30 years, VOO has delivered an average return of about 10.33% annually, slightly edging out total market averages in some periods. While it is a little less broad than VTI because it doesn't cover small-cap companies, it provides more focus on well-established businesses with long, proven histories. For retirement portfolios, VOO stands for strength, resilience, and steady growth over the decades, the kind of solid ground you want under your feet, no matter what the future brings. Vanguard Dividend Appreciation ETF, commonly known as VIG, takes a slightly different but equally powerful approach for building long-term wealth. Instead of concentrating only on stock price growth, VIG targets companies that have a strong and consistent history of raising their dividends year after year. That kind of reliability becomes incredibly important when you're living off your investments during retirement, depending on steady income streams. VIG charges a slightly higher, yet still extremely reasonable, expense ratio of 0.05%, offering excellent value for what it provides. Historically, it has delivered annual returns of about 10.61%, striking a balance between growth and income that very few funds can match. Its current dividend yield is around 1.88%, which may not seem massive at first glance, but the real magic lies in the fact that these payouts steadily grow over time. Companies included in VIG tend to be high-quality businesses with solid balance sheets and leadership teams that prioritize rewarding shareholders. They are often better equipped to survive recessions and economic shocks compared to companies that do not consistently increase dividends. For retirement savers who want not just income, but income that grows and keeps up with inflation, VIG is a smart, reliable, and forward-looking choice that fits perfectly into a long-term portfolio. Vanguard Total Bond Market ETF, BND, provides a different and essential kind of stability for a well-rounded retirement portfolio. While stocks can offer exciting growth potential, they can also bring along big swings in value, sometimes at the worst possible moments. Bonds, by contrast, offer consistent income and protection against the extreme ups and downs of stock markets. BND invests across the entire U.S. bond market, giving you exposure to a wide mix of assets, including U.S. government bonds, high-quality corporate bonds, and mortgage-backed securities. With an ultra-low expense ratio of 0.03%, it remains highly cost-effective to hold for the long term, ensuring you keep more of your returns. Historically, BND has produced around 4.3% annual returns, a figure lower than stocks but achieved with much less risk and volatility. In times when stock prices tumble, bonds can serve as a buffer, helping to protect your nest egg from serious damage. BND currently offers a yield to maturity around 4.6%, providing meaningful passive income that can support a stable retirement lifestyle. It's important to note that bonds are sensitive to rising interest rates, which can cause temporary price declines, but over a full market cycle, their defensive qualities shine. In a balanced retirement strategy, BND plays an absolutely essential role by reducing overall volatility, delivering steady income, and helping to preserve capital when the unexpected happens. Vanguard Real Estate ETF, widely known by its ticker VNQ, offers retirement investors a powerful way to tap into the real estate market without the headaches of buying, managing, or maintaining properties. Instead of dealing with tenants or worrying about property maintenance, investors in VNQ get diversified exposure to real estate investment trusts, REITs, that own income-producing properties like apartment complexes, office towers, shopping centers, warehouses, and even hospitals. Real estate tends to behave differently than traditional stocks and bonds, which makes it a valuable diversification tool for building a more resilient retirement portfolio. Historically, VNQ has delivered strong returns, averaging about 9.31% annually over the past 30 years, while currently offering a healthy dividend yield of around 3.5%. Although the real estate market can experience sharper fluctuations, especially during periods of rising interest rates or economic slowdown, real estate assets tend to appreciate steadily over the long term. VNQ also offers some built-in protection against inflation, because as the cost of living rises, property values and rental incomes typically rise too, benefiting REIT investors. By including VNQ in a retirement portfolio, investors can add a reliable income stream backed by tangible real-world assets, while also smoothing out the unpredictable ups and downs of stock-heavy investments. Over time, that extra layer of stability and income can make a meaningful difference when you're relying on your portfolio to support your retirement dreams. Building a retirement portfolio is not about chasing the latest hot stock or trying to beat the market every year. It is about building steady, reliable growth, protecting what you earn, and preparing for decades of living with dignity and comfort. Vanguard's VTI, VOO, VIG, BND, and VNQ offer a diversified, cost-effective, and powerful strategy for achieving that future. By combining broad market exposure, dividend growth, bond stability, and real estate income, you are setting yourself up not just to retire, but to thrive. If you found value in this guide, make sure to like this video, share it with someone planning their financial future, subscribe to the channel for more straightforward investing insights, and don't forget to press the bell icon so you stay updated every step of the way toward a stronger retirement.